We are very delighted to have with us Professor Martin Gruber. He is a professor emeritus and scholar in residence in the finance department at the Stern School of the New York University. Additionally, he's a director and a member of both the executive and the investment committees for the NBER, the National Bureau of Economic Research. He's also a director of the Japan Equity Fund, the Singapore Equity Fund, and the Thai Equity Fund. Previously, he served as chair of the Equity Committee and member of the DWS Mutual Funds New York Board, a member of the Board of Trustees of TIAA and CREF, the latter of which he chaired. His book, Modern Portfolio Theory and Investment Analysis, is one of the leading texts in graduate business schools around the world. His undergraduate degree from MIT was in chemical engineering, and then he found the wisdom of his ways and proceeded to work on finance. He got his MBA and PhD from Columbia. Now, he told me previously, a moment ago, that he's been doing a couple of really interesting studies, so I commend his webpage to you. One is on closed-end funds, and bond funds in particular, and the other was if I can say this, Marty, a paper which he was forced to retitle. The paper was initially titled The Relationship Between Size and Performance. However, the current title is The Relationship Between Mutual Fund Size and Performance. Far more sedate. So with that, let me introduce to you, please, Marty Gruber. Thank you.
Thank you for that kind introduction. Even at my age, we live in the tyranny of the referee, and I think the referee was wrong in making me change that title, but it was a small price to pay to get it in print. I'm going to set this up so I don't run under. I'm going to talk about, Olivia said, what would you like to talk about? And I said about 20 minutes. So that's what I'm going to do today, and I'm going to use this to talk about some research I've done over time in a few papers, and I have co-authors on these papers, and I always like to thank my co-authors. Those of you that know my work know that the vast majority has Ned Elton as a co-author, and also Chris Blake, and they were co-authors on these papers. In fact, Ned and I have worked so long together that I very often get mail addressed to Professor Elton Gruber. My topic is very different. I enjoyed this morning's session very much, and my topic is very different than those sessions, but in another way it's not. There's been a tremendous amount of work on how individuals act in pension funds, how they act in 401k plans, the role of investment advisors in those plans. But there's been very little work done on the plan sponsors and the alternatives that investors are offered. And if you really think about the participant in a plan, he's making a choice within a set of options that he's offered, and the options can be equally as important as the choice he makes among them. And so what I want to talk with you today is about how well plan sponsors do in selecting mutual funds. Now, why have I selected mutual funds? A couple of reasons. One is we really know how to measure risk in mutual funds. And the second thing is we have audited data. So when I know what mutual funds you hold, I can get all the data I need about those mutual funds. There are two problems here, and I'm going to address the smaller of the two problems. The first problem is, does the sponsor offer the right types of mutual funds and enough of the types of mutual funds? We can chat about that in the question and answer period, but that's not what I'm going to address today. I'm going to address a much more defined topic, which is given the choices that are offered, given that I've decided to offer a type of choice, a growth stock fund, have I picked the right funds? So we're going to look at choices within each type. That's the main part of my talk. I'll put on a couple other things that interest me. One is the persistence in plan performance. The good plan sponsors tend to stay good over time. The poor ones stay poor over time. So we'll look at that for a minute. And then my pet topic, which is how are participants in the plan affected by returns in different assets? How do they act when some assets do well and other assets do poorly? And so I'll finish up with that. I'm going to have to use something called return-based style analysis. Now, some of you are very familiar with this, I'm sure, and some of you have probably never heard of it. So the next slide will be for those of you that are familiar with it. For those of you that really don't know what it is, alpha is simply a measure of, it says you have to plug in your computer. It's your computer. I take no responsibility for this.
Is it plugged in?
While he's plugging it in, alpha simply, when I talk about alpha,
I think you're good.
alpha is how much better the mutual fund is on the plan is than a set of index funds exactly the same. I'll say that again because I didn't have the mic. So those of you that want to think of it simply, alpha is just simply how much better the mutual fund or the plan did than a set of index funds with the same risk. For those of you that want to know the methodology, this is standard methodology. Bill Sharp and I wrote about this methodology 20 years ago. It's become known in the industry as return-based style analysis. And simply the way you generate or measure alpha is from a regression where you have a set of indexes on the right-hand side of the regression which span the type of securities the mutual fund does or might hold. And I'm not going to read off the list because it's dull, but for those of you who want it, this is a list of the indexes that we used. So we're measuring how well did the fund do than this set of indexes with the same risk. You're not going to electrocute me, are you?
I'll try not to.
Okay, good. Now, this is the first part of the study, and this is very standard. Everybody does this. Everybody that writes about mutual funds does this. But I want to take it a step further, because we know that mutual funds in general have negative alphas. So if I pick mutual funds at random, they're going to do worse than index funds. That's documented in dozens and dozens of studies. We're going to use a separate measure, second measure here, which I'm going to call differential alpha. And this is original to this research. It simply says, how does the alpha on the funds selected by the plan sponsor compare with the alpha on the same type of fund selected randomly? In short, did the plan sponsor given that the plan sponsor decided to have a growth fund, did that growth fund do better than a randomly selected growth fund of roughly the same size? And this is, I think, important and hasn't been used before. Now, there are two ways to get alpha on a plan, or we use two ways. One, which is the one that's generally used, is to simply take an equal weight on each mutual fund the plan holds. So if there are 10 mutual funds, you assume 1/10 in each investment. The second one is to aggregate by the percentage of the participants' holdings. So the alpha on the mutual funds are actually weighted by how much money the participants in aggregate put in that mutual fund. And the second measure is important for two reasons. It represents what participants really do, and it lets us see whether they add or destroy value by choosing among the funds. The punchlines in the paper are fairly simple. This is the first of my two major punchlines. If we look at across all the plans in our study, if we look at the alpha on the plans, we see that the average plan The alpha on the average plan is 31 basis points a year worse than holding index funds of the same risk. So this is a good news, a bad news, good news story. The bad news is you don't outperform index funds. The good news is you do considerably better than buying mutual funds of the same type at random. So you're bringing expertise to bear in selecting mutual funds. The sponsor is doing his job in that sense, but he's not doing it well enough to overcome the differential from index funds. When we look at this, those of you that like those niceties, there's statistical significance at the bottom. If we look at alpha, we see that 65% of the pension funds do worse than index funds of the same risk, thereby 35% do better. If we look at it compared to funds of the same type, mutual funds of the same type, 75% of the pension funds do better than randomly selecting funds of the type they've chosen to offer their participants. Those of you that like statistical significance, the differential here is statistically significant. There it's not. Okay, that's the first part. This just reiterates what I just said. The question is, how do participants do? If instead of using equal weights, we use participant weights, how well does that work? And the answer there is that participants actually destroy value. They don't add value. You know, you could say, okay, it doesn't matter if I give the participant a bad mutual fund, because he's going to avoid that. He's not going to pick it. Well, that's not true. If you look at it compared to index funds, compare the 0.31 to the 0.52, the participant actually does worse than equal investment. And you could say, okay, because the participant has a whole bunch of reasons for investing. But if you look at participant weights rather than equal weights, which are the two blue numbers, again you see that the participant does worse than equal weights. So it's really important to choose the right funds. Because if you don't choose the right funds, the participants are not going to undo your mistakes. They're going to make your mistakes worse. And that's good to know. What I guess let me tie this back to what I heard this morning. A tremendous amount of emphasis on giving advice, which I think is very useful to plan participants on how they should invest. That's great. You should be doing that. But I want to make a plea for also giving advice to plan sponsors on what they offer the participants, because that's equally as important, and you just hear a lot less about that. Okay, the choices of plan administrator is very important because participants destroy value rather than increase value by their decisions. Do we find that sponsors are consistently good or consistently bad? Do they tend to perform well or poorly over time? You can forget the boxes, that's for statistical significance, but just look at the results on the right-hand side. What I did here was to take the plans, this is differential alpha, I took the plans, I ranked them from the worst to the best, and then I looked at how well those plans did in the following 1 and 3 years. So we're asking the question, the plans that do well in one period tend to do well or poorly in the next period. And the answer, and this is not unusual in any kind of mutual fund data, what you find is that bad mutual funds, bad sponsors, have a real tendency to continue to be bad. Very strong predictability in the lower tail. Whether they're not paying attention or they're being sold funds by a fund family that's inefficient, I don't know. But this lower tail, the differential alpha, a minus 288, this is very strong and shows up very strongly over time. In the positive end, there's predictability also. Not as much, but good fund sponsors, good fund managers, tend to remain good over time. Poor sponsors have a tremendously strong tendency to remain over time. How am I doing on time? My thing, 10 minutes or? Okay. Now, I tried to look for other measures. I'd love to be able to predict in the future how well plans are going to do. And you're never supposed to tell an audience that you tried stuff and it didn't work. But these are all the predictors I tried. And I tried dollar size of the plan, number of choices, changes in choices, new cash flow, presence of a money market fund. I found no relationship whatsoever, except for past performance. That's the only thing I could find. How do plan sponsors work? Well, one of the strongest things that I found in the study is that sponsors tend to chase performance in categories, and they tend to chase performance in individual issues. They tend to buy the hot categories. If growth stocks did well, they'll add these. I looked at deletions and additions to the plans. If growth stocks did well the last year, they add growth stocks. If growth stocks did poorly, they dump some growth stock managers. So they tend to react to types of mutual funds very strongly, and they tend to react to individual funds very strongly. If I look at the difference between funds that are added and funds that are dropped before the action, funds that are added do 2% better, 2% a year. That's a big number, better than funds that are dropped in the year before they're dropped. In the year after they're dropped or added, I followed both the dropped funds and the added funds, there's almost no difference. Perhaps the dropped funds do a couple of basis points better, but it's almost non-existent. So there's a lot of performance chasing, and the performance chasing doesn't seem to add a lot. Okay, I want to ask you a question, because you're all in the industry in one way and another. Let's think about how participants can react in allocating their money. Participants can restore the weights. Weights change because of different returns on different funds and different categories of funds. Participants could act to restore their weights as they were before the returns came in. They could do nothing, either because they're lazy or because they think everything's random. They sort of believe in the absolute efficient random walk theory, and so they just let it ride. Or they can chase performance and put their money in the things that did well. How many people think they act to it? And you know, I'm not sure there's a right. Yeah, there is a right answer. I can't lie to you. There is a right answer, but because we know. But how many people think they act to restore weights? Okay, how many people think they just let things alone? And how many people think they chase performance and put more money in the ones? Well, the answer is, I'm not going to go into the statistics. I have slides on it. But the answer is, the last two groups are sort of right. They go about halfway between doing nothing and chasing performance. So they chase performance. Half the money chases performance and half the money lets it ride. And there's no tendency to go back to original weights. This is methodology. I could talk about the methodology, but I will afterwards if anybody wants to corner me, but I don't feel like going through equations. Let me conclude, and we're going to have lots of time for questions, and answering questions is much more fun than giving a talk. What do we learn? I think we learned that the action of plan administrators or sponsors is vitally important. They really have a tremendous impact on how well participants do. Aside from all the things that we were talking about this morning, if you don't give the participants the right choices, you're costing them money. And we see that participants don't add value. Their choices don't add value, so your job is to get them to add value. You don't outperform index funds, and they do offer portfolios of better than random active funds. Now, there's a new study, which is kind of nice, by Keith Brown and Harlow, which uses a different time period and a different methodology than my study. And they find that two things that the same as I did, but they studied something that I couldn't study in my database, which I found intriguing. The option, they concur that the options offered by pension funds, 401k plans, don't outperform index funds, and they do outperform actively managed funds. But they, because of their database, could do something I couldn't do that I found intriguing. They had data, I did not have data on private accounts. They had data on private accounts. And the reason you do research is to learn something you don't know. And I was surprised. They found that the private accounts, were, in terms of performance, were virtually indistinguishable from the mutual funds. The theory is that private accounts do better. This is a large study with a lot of data. And they found in their study that the private accounts, adjusted for risk and everything else, and compared to mutual funds that did the same thing, did no better nor no worse. And how much time did I use? I have 2 minutes left, and I'm gonna turn it over to you, as they say in Congress. You can have my time. I'll open it up for questions. And what
do you mean by private account?
I go anything that's not a mutual fund that I hold there.
By individuals or?
No, these are pension. This is a pension fund, and if they're individuals that are holding individual stocks, like that would be the aggregate of those individual stocks. Could be a brokerage account, could be a manager that manages a commingled fund. Anything that's not defined as a mutual fund. What?
Employer stock?
No. I thank you for asking that. That's very important. I have taken employee stock completely out of the study. I've taken two things out of my study. When I've talked about active managers, I've taken out index funds because I don't want to be measuring index funds again. And I've excluded employee stock. We all know that there's overinvestment in employee stock, and just about any way you can define overinvestment. The thing that surprised me that I learned not from these studies but from another study, academics are trained to be skeptics, and I would have thought that the companies that offered private stock, their own stock, and particularly those companies that made their contributions in terms of private stocks, would offer worse options outside of private stock and the pension, and they don't. I would have, because I'm suspicious, I would say we want to push private stock, so we're going to give bad options outside of private stock. That's not true. People do overinvest in private stock. If they're given private stock, they tend to put even more money in private stock. They're overinvesting in it, but the company's not messing with the other options. Yes?
We have a mic here, if you would be so kind as to tell us who you are and use the mic.
Yeah, Richard Shea from Covington and Burling. And what time period did these was the data drawn from?
Well, I'm really using two studies here, and what you have is basically the last study One study goes back from 2 years ago, going back 10 years, and the other study is the 10 years before that. So we're covering basically, between the two studies, a 20-year period.
So you don't have, I was just curious whether, I think I know what the answer to this would be, but you know, the Department of Labor has qualified default investment alternatives, and I guess what you would probably say is, well, it depends on which ones the sponsor picks as to how well they do, but I was...
Yeah, I'm not saying anything today, and I want to make this clear, about, and we can talk a little bit about the number and type of options, but I'm not addressing that issue today. I'm just saying, given what they decided to offer, that they do better. Because you can find index funds. You can put together a bundle of index funds for your default option if it's a plan that has a year ending date. All I'm saying is that could they have done better for the participants by making different choices? And the answer to that is yes. But I'm not addressing the big issue, or in one sense the big issue that you're addressing this morning, which are the investors saving enough for retirement? Are they looking at their plan properly in terms of risk attributes? I'm simply addressing something that I think has been almost exclusively not addressed in the literature, which are the plan sponsors making good choices, not in the broader sense, like a default option, but given that they're going to offer particular types of plans, are they picking funds, are they picking good ones, or are they picking bad ones?
Sorry. Stacy Schaus with PIMCO. So you talked about how the assets were allocated in the beginning of the study. So I'm assuming stable value, fixed income, or what % of the options were equity versus other?
Okay, thank you again. You get used to this and you don't make all the details clear. I'm only studying equity options in this paper because there are fixed income options, and when we did an efficient frontier and all that stuff, we included those. But when I'm looking at alpha, which is what I'm looking at here, I was really concerned with the stock options because that's where I think there are vast differences in the returns offered by the different mutual funds. Sure, there are in bonds too, but they're not nearly as severe as they are in the stock area.
U.S. versus international.
Oh, okay. Yes. U.S. No, we have international funds in there. And in fact, if you go back, way back, for international funds, we benchmark them against the S&P because many of them have American stocks or foreign stocks that are dependent on that. And we used the 3 MSCI indexes, Europe, Pacific, and emerging markets. And I take that back. We did do bond funds. I apologize. It's in the other study we didn't do it. When we use bond funds, we benchmark those against a general government credit, a mortgage-backed, a high-yield index, and a world government bond index. In another paper, which I published before this, I asked if you were looking at bond funds, how many indexes were necessary to explain the performance of those bond funds. And so these bond indexes weren't pulled out of a hat. They were pulled out of that previous study where we found they were sufficient to describe bond fund performance.
Kelly?
I was surprised, by the way, at how much money was in international securities. It was about 7%. I'm remembering that. And I was both surprised and pleased that it was that high.
Kelly Hewler Companies. I'm curious if you have any data on the plan sponsor's resource in terms of making the decisions that you're describing as either poor or they were good sponsors and they had good performance or they had poor performance. And I'm wondering if you have any data on whether or not those two groups show any difference relative to whether they use consulting resources to help make the decisions.
I have a little bit on that, not as much as I'd like. The problem here is data. It's very difficult to get good data. And the little bit I have says that pension funds that are larger tend to do better than pension funds that are smaller, and that pension funds that use consultants or advisors tend to do better. But I have to warn you there that I don't have enough data to disentangle those two events. So larger funds are more likely to use advisors. Funds that use advisors do better. Funds that are larger do better. Plans that are larger do better, rather. And I can't tell you which of those, whether they do better because they're larger or they're better because they use consultants. I can't differentiate between those two economic phenomena.
Going forward, one of the things that you just mentioned is key size of the sponsor. And the smaller the sponsor, the more likely they are to depend on less unbiased advice, more product-driven advice. And that might be something that would be of interest going forward.
I suspect that statement is true. I have no evidence of it. I mean, I talked to, there's a group that Steve Mayer runs of small and mid-sized pension managers, and I address that group every year, and for the last 15 years. And I'm surprised at the range of knowledge. These are people that are running pension funds. I'm surprised at the range of. I keep adding lower end stuff to my presentation because somebody from an unnamed place that I think of as with a halo around it said that she didn't realize that there were different expense ratios. And I mean, that just blew my mind. So there's very different, and one of the reasons I give a talk there every year is I like to sit around and talk to the people. These are people making investment decisions, and I find some really sophisticated people, and I find some people that usually come out of human resources and have no finance training, and that's just I feel that the pension fund area and retirement planning is one of the most important problems in America today. So when I meet people doing the job that aren't doing it right, it upsets me. Yeah.
Rick Miller, Sensible Financial. You say you excluded the index funds, but it might be interesting to know if the plans that included some index funds made better choices. And it might also be interesting to know if the employees in the plans that included index funds chose the index funds or made better choices.
That's a very good point. And thank you. I have ratings of points that people make. The highest rating I can give a question is when I write something down, which I'm about to do. So give me a minute to write it down. I didn't think of it. And it's a good point. So you get a star for that. That's good. My next paper. Yes.
What was the role of fees in this? How did you control or account for?
Everything's after fees. I want to know how. In fact, if you look at, I didn't mention this on the slide, but if you look at how well plan sponsors do relative to other active managed funds, about half of that difference is due to fees. So they're doing something beyond fees, but fees are being able to get lower fees are a large part of that.
Did you have any controls for custodians or plan administrators and the associated fund families therein, or was that not allowed for in your study?
I'm not sure I understood the question. Could you do it again?
There's a lot of concentration in the administrators and custodians of 401k plans.
No, I didn't study that. It's another good point. One thing I did in a separate paper, unrelated to this, but not unrelated to it. I'll tell you the story of why I wrote the papers. At my age, I do research just because I want to know something. And there's no other reason. And I was sitting in a mutual fund board, and the growth stock manager came in and said, well, I'm buying IBM because it's a growth stock. This is many years ago. It's going to do really well. I said, listen, I was head of the equity committee. And then the value stock manager came in and said, I'm going to buy IBM because it's a value stock that's going to do really well. So that got me, so they made them come both in together and battle it out. And that got me thinking. And so I did a paper in the Journal of Finance where I looked at the correlation between returns on funds that are offered by the same family versus returns on funds that are offered by different families. And you could say, why do you do that? It's obvious. Well, it is obvious in a sense, but because what happens, the economist comes in and everybody listens to the economist or doesn't listen. And what you find is the correlation. But if I take two growth funds in one company, or a growth and an income fund in one company, and compare that growth and income with across companies, it's much more highly correlated within the fund family. That doesn't mean you shouldn't, if you find a fund family that does a really good job on alpha, you should put your money there. But you should be aware that when you stay in one fund, particularly if it's one management family, particularly if it's a small one, you might be getting very high. You may not be getting the diversification you think you're getting.
Hello. Hi.
Hi.
Oh, gosh. Melissa Kahn, MetLife. So I want to build on the fee questions, and I'm going to ask Stacy's question, actually, because I have the same one, which is when you said that the actively managed, you took the fees out, did you do the same with the index funds? That's question one. And then, if I heard you correctly, you said that the index funds weren't really part of the study that you did, but isn't the conclusion, which you had up on the last couple of slides, that the index funds, we should all be invested in index funds?
No. When I said they weren't part of the study, when I wanted to study active managers, I just took the active managers, and then I compared it to index
right,
funds.
But the point is, from what you said, is that the actively managed funds don't do better than the index funds. We should all just have index funds, but
you could convince me of that.
But to Stacy's question, I'm assuming that the index funds were also net of fees?
Yeah.
Okay.
And what I did, it's one of the few things, not in all my research, because research is more like biology than physics. You learn things over time. I actually use index funds on the right-hand side of the equation instead of indexes. In other words, when I'm comparing, I compare with ETFs and index funds as opposed to indexes, because indexes, an index fund has costs. And it's not just the expense ratio, there's a certain amount of trading cost. And so if you're really going to, and I think I'm the only person that does this. I had to take it out of one paper because, again, a referee didn't like it. But I'm an advocate, a strong advocate of comparing with index funds, not indexes. It's just so much easier to do it with indexes. I've tried to get, I know I have a friend who's with an indexer in the audience. I will make my pitch. I've tried to get suppliers of indexes to make those suppliers of an aggregate of index fund data like there are 180 S&P index funds. And I think it would be very useful to the industry if you had indexes of index funds and not just indexes. And look, I do some work for FTSE, and FTSE last count had 762 indexes. I think they could afford a couple more. That I'm pushing them to do this. It just makes a lot more sense because you're right. I think we hurt active management when we compare it just with indexes rather than index funds. On the other hand, do I really believe in index funds? Yeah.
One last question. Anybody going once? Going twice? Well, thank you very much, Professor Gruber, for both informative and educational. And
well, thank you very much for having me.
Thank you.
And you've been a nice audience. Thank you.